Hey, good morning, everyone. Marty Mazzora here. It is Friday, the 22nd of August, 2025, about 2.5 hours after the U.S. equity market cash session open. I'm going to do the end of week video right now. I'm looking at today's calendar and then my schedule over the weekend. And I just realized that this is my best shot. So I'll still be scoring our index and all the things that I do over the weekend. And if I really feel compelled, it'd probably be late Sunday that I put something else out for you, but I'm not expecting to. So look again after today, midweek next week or so for something else to follow up. So good timing as well, because the minute the speech was released this morning, the written version for Fed Chairman Powell's Jackson Hole Conference presentation, stocks went from slightly in the red to tremendously in the green, at least for a one morning session anyway. And clearly the market was looking just for confirmation that there's going to be a rate cut in September. As I've said the last video or two, that pretty much was a lock based on market expectations. Even yesterday, after some somewhat jawboning relative to inflation risks and that sort of thing, maybe by some Fed governors that intimated or maybe hinted that maybe there wouldn't be a Fed cut in September, odds went from like 90% to 70% of a cut. The Fed is not going to buck a market anticipation or an expectation of a 70% chance of a rate cut. But as I said, and this is still the case, by the way, as the August data come in, that could change. Right now, though, the market got what it wanted and really struggling. Volatility's been high this week. Markets traded lower. It makes some sense to me that suddenly there's this kind of fear of missing out reaction to, oh boy, Powell is on board. Now, as I've said over and over again of late, we do think that a September rate cut is going to be appropriate because our view of the data is that it's softening to the point that allows for that. Our concerns, however, are that inflation doesn't seem to be going anywhere. Now, when you take the statement verbatim, it is interesting. I don't know that I would have anticipated quite this reaction, and I will say it's a knee-jerk reaction. And by the way, that reaction in markets is, first of all, since I have it up, you can't see it, but our core allocation is up 1 full percentage point, which is a nice move, in a 2-hour span. The S&P is up 1.5%. Everything in our core is up except for Indian equities, Vietnamese equities, and AT&T. Everything else is up. Consumer staples in the U.S. actually were down most of the morning so far. They're flat right now. And those are the big blue chip companies that sell you stuff that you got to buy to keep living. And so what's been really rocking and rolling this morning is the stuff that's been getting beat up of late. That would be, largely technology stocks. The S&P Tech Index is up 1.6%. What's also interesting, too, is that the bond market is rallying. I'll show you yields here in a second on the 10-year. So our long-term Treasury ETF is up almost 0.75%. So this is viewed bullish for bonds as well. So this is not that September reaction, at least not yet, that last September reaction where the Fed cut 50 basis points and mortgage rates went up. Makes me wonder if they'd only cut 25, if maybe it'd have been a better response. Maybe 50 was considered too stimulative. If the economy remains pretty strong, if the data over the next month come in pretty strong, then it's really what the bond market does when they actually cut rates. That's the risk that rates will actually move higher. Right now, there's enough weakness in the economy. That last jobs report was really a stunner or a shocker in terms of what it did to economic sentiment. Powell again said this morning that weakness, in fact, let me just pull up some notes here and I'll tell you what he said. With policy in restrictive territory, they would like to have you believe, and I'll leave it there. The baseline outlook and the shifting balance of risks may warrant adjusting our policy stance. And in the near term, risks to inflation are tilted to the upside, If that were all he said, the market would be selling off 2% right now. And the risk to employment to the downside, a challenging situation. When our goals are in tension like this, our framework calls for us to balance both sides of our dual mandate. So when he says we're in restrictive territory, and then he says we need to balance, that is essentially just a guarantee that they need to lower rates a bit right here. With regard to tariffs, the effects of tariffs, this is from Powell, on consumer prices are now clearly visible. And a reasonable base case is that the effects will be relatively short-lived. A one-time shift in the price level. Now, I've talked about that a bit lately. That is probably not the way to view this, although he does say, on the other hand, of course, this is from him, one time does not mean all at once. It will continue to take time for tariff increases to work their way through supply chains. I've talked about that of late. And distribution networks. Moreover, tariff rates continue to evolve, potentially prolonging the adjustment process. And with this risk too, it is also possible, however, that the upward pressure on prices from tariffs could spur a more lasting inflation dynamic. And that is a risk to be assessed and managed. And that's kind of what we've been talking about. One possibility is that workers who see their real incomes decline because of higher prices demand and get higher wages from employers, setting off adverse wage price dynamics. And the dynamic in the labor market right now is interesting. We see both a contraction in the supply of labor, a la the labor force participation rate. We know that we don't have the immigrant influx into the labor market like we've had, and the job openings numbers have been going in the downward direction of late as well. The latter being a reflection of demand for employment. Okay, so you put those together, and absolutely, I think the Fed needs to be concerned about labor outcomes going forward. And so we'll see. We'll see how that shakes out. A lot of stuff, remember, with regard to tariffs, there massive amount of inventory had been built up. Talked about that last time in the car space. Now that inventory has been used up, so now we have to see, who's gonna pay the price of these, and we really don't know where they're going to end up anyway. There's still a lot of negotiation going on. The market is assuming a good outcome there, clearly, or an outcome that's not going to roil the economy. We also have quite a spending package that's going to be coming to bear on behalf of the economy as well, and then I can get into the inflation aspects of that too, and all the government borrowing that it's going to take. So something that offsets it in a negative way, the market might like right here. So obviously a lot more to talk about. We will see next week when the market gets to really digest and we get over this immediate knee-jerk reaction. But certainly positive. I'm certainly not complaining right now as it relates to how our clients are doing today. But there's lots going on in the world, lots for us to think about. The first chart you have right there is that monthly chart. And I have made the case, in fact, history has made it for me, that if you're worried about the market in the short term, you don't want to be here on the relative strength index on the monthly chart. That's overbought above the red line. And these just don't seem to resolve without double-digit declines. And it's that last overbought reading that finally rolls over. So here you can say, well, we had our 20% decline this year, and I'd say you're right, but we're right back in overbought territory. You can see that happened here. That was a 20% decline, and then we were right back in overbought territory. They just almost never resolve without a pretty good correction. This could happen this time. Lots of new things going on in this world, as I mentioned the other day. So we'll see. But this is just a warning flag, on a short-term basis. Good thing we're not short-term investors. When you look at the daily chart, you can see that this big thrust, and this is today, the market is right back up there testing that all-time high, right? So if indeed this breakdown is legit, this is a very normal back test, technically speaking. You still have your sell signal right here. You still have your bearish divergences. So I don't know that we're out of the woods yet. We're certainly not when you look at the market from a technical perspective. The NASDAQ 100 index, that 20-day moving average, which is so key on a short-term basis, has been recaptured, finding resistance right here on this downtrend line this morning. If that were to fail next week, the NASDAQ would resume its sell-off and we'd have further to go. Tech stocks are pretty much what we call long duration stocks. They're discounting earnings way into the future. As you should have noted in my presentation day before yesterday on the AI versus the dot-com scenario of the late 90s. And therefore, they're pretty sensitive to interest rates. So it would partly because of things like Facebook stopping a lot of their AI spending, and certainly with labor and other companies that have just been pouring CapEx, and that's one of the risks that I've been talking about. If that begins to wane, that's going to probably do a real number on the tech space. So I think some of this sell-off had to do with that fear. Some of it had to do with this thought that maybe the Fed isn't going to do what the market wants it to do. This is also potentially the makings of a bear flag pattern. So I'm not saying that we should be necessarily bearish. This could stick. We could be roaring into new all-time highs over the next few weeks and months, but we need to keep our eyes and our minds open to all possibilities. The dollar is reacting to interest rates today, so the dollar is coming down, and that's been very bullish for gold, which I'll show you in a second. Here's the 10-year yield dropping dramatically. That says that the Fed is right to be cutting interest rates and that the economy is waning, and that so the bond market is confirming right now that a Fed rate cut in September makes sense, and that's what we've anticipated, that it does make sense. But I'll say it again, a lot more data yet to come out, so we'll see how that plays out. I said the other day that gold could sell off a lot, particularly if the equities rally into Chairman Powell's speech today. Well, I was wrong, certainly based on the morning reaction. Gold is reacting to that weak dollar and lower interest rates. That makes gold more attractive. We shall see. So it's doing battle right here with what has been resistance, and that's that 50-day moving average. The technical chart for gold is not bullish right now, but we are very bullish from a long-term perspective on gold, not so much just based on the charts on a short-term basis. So yeah, folks, I could easily ramble more, but I think that actually pretty much covers the news of the morning, our thoughts on that. If you didn't get to watch Wednesday's video, I think that was an important one to watch, and even the one before that, which was last week's end of week video, and also the written blog yesterday. I took quite a bit of Howard Marks' latest memo, which is one of the most highly respected periodicals in our industry, by the way. So take a look at that and my highlights about conditions and valuations and all that good stuff. Folks, thank you as always for watching and listening. I hope you have a great weekend, and I will be back soon. Take care. Bye-bye.